Ladies and gentlemen, I am strongly considering making a move on PayPal, okay? PayPal is one of these companies that has been absolutely obliterated price-wise since their highs in 2021 of about $300. Okay, we're now down in the mid-60s range, which may as well be all-time lows for the company, all right? I think they might have dipped below, yeah, they dipped just below 60 very briefly, but in the grand scheme of things, we're basically at all-time lows for PayPal. Now, it's no secret that I think this is a great business with a lot of potential. They impress with their revenue growth, which has slowed a little bit lately, although as companies get bigger and bigger, it's normal for revenue growth to slow as time goes on. You can't put up 20, 25, 30% growth forever, okay? Now, PayPal has also had a slight contraction in their EPS numbers, but their free cash flow hasn't really declined much at all. So I think that the earnings compression is probably temporary, and I think that they're bound to improve this profit margin number back to previous low to mid-teens levels at least. Okay, so before we get into a price target, I want to just remind you, when it comes to analyst price targets, I don't really pay attention to these things, okay? This is just where they think the price is going to go in the next 12 months. It's not really a fundamental thing as far as I'm aware. Maybe it's what they think its valuation should be, and they think the price will go to that valuation, or maybe it's a technical thing. I come up with my own target because at the end of the day, if I'm going to be comfortable owning something, the price has to make sense to me. But what I do look at as a starting point for those calculations is what the analysts expect in terms of earnings and earnings growth in the short run, meaning the current year and the next few years out. Which, granted, this is just a starting point. They're projecting just under $5 worth of EPS for this year, with double-digit growth over the next few years. Okay, so that gives us a starting point as to what might be a reasonable assumption to make when we run a discounted free cash flow model. Now, I tend to go a little bit more conservative than what the analysts do. So, as our starting point, we'll do this year's, because I think the nearer term that we are, the more accurate it will be. Give them credit for the tangible book value. And for a growth rate on the EPS, I think we need to give this a pretty good haircut. Let's see, they're talking about 14.5, 11, 18, 22. For the next 10 years, though, I think we ought to go with maybe 8 or 9. So a little bit more conservative than what they're saying. And frankly, I want a little bit beefier return than 10%, so my discount rate's going to be higher. I throw in a 12.5% discount rate. Well, there you go. I come out with a $73 valuation if I want to get a 12.5% return with the assumption of 9% EPS growth over the next 10 years, on average, with 4% thereafter. So this is why I'm strongly considering making a move with PayPal, because we're 10% below the price we would need to be at for me to get a 12.5% return, making assumptions that I think are more conservative than what the typical analyst is making for their EPS growth. So that, to me, has the indicators of value, okay? And that's really what it's all about to me. You can say, oh, I think the stock is going to go up to here, and, you know, that may come to fruition, but I think the stock is going to go up is not a valid justification for coming up with what price you're going to pay for it. But projecting what you think the sum of its future earnings and cash flow will be, okay, putting assigning a dollar amount today that you would pay for that future cash flow. Now that, to me, is the essence of investing. And so with this, I definitely, I'm definitely strongly considering doing something with PayPal in the near future. I haven't made any final decisions yet, but this right here is the reason why. Okay, it's just that good of a value right now. But as you can see, another point: this thing a couple years ago was trading hands at like $300. Okay. As you can see, we are nowhere in the realm of justifying a $300 valuation. So what would we have to do to get to a $300 valuation? Well, first, I'll put my desired return down to 10% to be more, realistic per se. What kind of growth would we need in the EPS to justify that $300? 25%? Doesn't quite cut it. All right, 35% is a little too much. 30% is a little too much. So call it in the high 20s in terms of EPS growth over the next 10 years on average, with only 10% desired annual return. So we would need tremendous EPS growth. Like, you can pull out your calculator and do the math on how many times their EPS would double in the next 10 years if they actually got this. Okay. And it's absolutely insane. Okay. That's all I'm going to say on that. Today, I think we're in a really reasonable place with the stock price, potentially even, a good chunk undervalued. And I think, a couple years ago, we were just in the stratosphere of insanity, ladies and gentlemen. So do with that what you will. I'll let you know if I happen to do anything with PayPal. Let me know what you think of PayPal's future and potential in the comments below. If you already have shares, what your cost basis is. Hop on Discord. We can talk about PayPal more, of course. And as always, stay safe and don't do drugs. Stay in school. All that good jazz. And I'll catch you on the flip side.